Okay. So, hello everyone. Welcome to the options swing trading strategy course. And for those of you who might have joined us last month during our starting out with options course, um, yeah, welcome back. In that last course, we did touch upon the very fundamentals of options trading, and this time around, we're going to get more into the meat and potatoes, or some of the meat and potatoes of options trading by kind of delving headfirst into swing trading. In fact, we're going to be diving into a very robust but very easy to implement options swing trade strategy that anyone really can deploy in just a matter of minutes every day. This strategy really is perfect for anyone who might not have the time to actively day trade or the time to sit in front of their computer monitors all day long. Or if you're like me and you do actively day trade, you might not be you might be looking to add a swing trade strategy to in order to kind of help diversify your overall trading business. Now, for those of you who might be new to the group, let me go ahead and introduce myself. My name is excuse me, my name is Ahmet Kandon. I am the co-founder of Down to Trade, and our goal at Down to Trade is to provide free options education to the masses. Now, we are very lucky to have with us today one of the most talented traders I've ever met, Varian Croft. Varian and I have traded together actually for many years. We have a very similar trading styles, but what he brings to the table is a set of technical skills that I do not meet up to. I don't possess his technical skills. He's a phenomenal technical analyst. And when I was considering opening up our new swing trade room, I really couldn't think of anyone better to make it happen. So again, we're very lucky to have him join us today and to be teaching this class. So that said, without further ado, I'm just going to go ahead and hand it over to Varian and have him take the course.
Awesome. Thank you, Amit. All right. So like Amit said, this is swing trading with options, and we're going to be diving into how to effectively trade credit spreads. So just a few things, how this is going to work. If you have any questions, please feel free to throw them in the chat room, and I'll be happy to answer any questions. We are recording this course, and with this, we do assume that you have an understanding, basic understanding of the stock market and options. So this isn't for the flat beginners, the very beginners. This is for people who do have a basic understanding of how the market works and how options work. Just get some of the legal out of the way. Disclaimer: by choosing to continue watching this course, you hereby acknowledge that there are risks associated with investing in stocks, options, bonds, indices, futures, exchange-traded mutual funds, and money market funds involve risk of monetary loss, substantial loss, or principal if possible. Some high-risk investments may use leverage, which will accentuate gains and losses. Past investment performance is not a guarantee or predictor of future investment performances. And as you see, we do not provide investment advice. All right, so moving on real quick here. The course overview. This course will cover how to effectively trade credit spreads by putting mathematical probability on your side. Little bit about me. I currently live in Naples, Florida. I have 6 wonderful kids, 3 boys, 3 girls. We moved here to Florida from South Texas back in July of 2020. I was born and raised in Orange County, California. While living in Texas for about 10 years, I owned and operated multiple businesses, including a construction company, trucking company, and a craft brewery. All of those businesses I have sold off to other individuals and moved on to other ventures. I started trading back in 2015 and became a full-time trader in 2020. And my primary focus for the past 3 years has been futures, 0 DTE, and math-based options trading. So starting out just with a quick little overview, what is a credit spread? So per Investopedia, the selling of an option contract and the buying of a further out of the money contract with the same expiration, effectively by exchanging two options of the same class and expiration. This strategy transfers credit risk from one party to another, limiting the amount of risk taken by a trader. So simply put, you're selling one option, you're buying another option further out of the money. That limits your overall risk on the trade. So why trade credit spreads? Well, like we were just talking about, one, it reduces your risk. When you sell naked options, the risk technically can be unlimited, which makes the buying power very restrictive. Using a credit spread, it is going to reduce that risk. It's going to give you calculated risk, and it's going to reduce your buying power needs in order to trade. So with credit spreads, what's our edge? Why is this the mechanism that we would want to trade? And the primary reason comes down to a mathematical equation that is used to effectively calculate what the expected move of a stock is going to be over a set period of time. So our edge is what we are going to be calculating against each other is the expected move, which is the expected move, which is calculated by one of three models. The most common that people are familiar with is the Black-Scholes model. But what this does is it calculates how much they expect a stock to move in a certain period of time. It's a very complicated equation. There's multiple things that go into it, but this is just the basics of what it is. And then there is what is called historical move. The historical move commonly underperforms the expected move. And with these pricing models, they tend to overprice options based on the expected move. So what this does is we are looking to capitalize on this market inefficiency of expected move versus historical move. And here's a bit of a visual for you. So here you can see, this is just off of Thinkorswim, that this is what the expected move calculation is based off of the Black-Scholes. And you can see your expiration dates here. So when you look at it, based on any of these expirations, this is how far the expected move is being calculated. So with that, what you see here is that Tesla at this time, was currently trading, I'm having problems seeing that. Oh, there we go. Was trading somewhere around the 255 level that I took this. So by November 24th, the expected move is saying that it could go, they're expecting a move as potentially low as 210 or as high as 299. So this is the expected move that is being calculated into the options chain. Now, this is historical move. Since the historical move commonly underperforms the expected move, this is what it looks like, commonly looks like for a stock. You have the expected move of up to 300 on Tesla or down to 210, but in reality, based on historical, it would be closer to these areas. And our goal is to take advantage of this market inefficiency in here. So now that we know what the edge is of trading a credit spread, the question is, how do we trade these spreads? Because there's a very specific mathematical way to do it to put probabilities on our side. So with trading credit spreads, the first thing that we need to look at is what is called the IV rank. This is an implied volatility measurement based on the specific stock itself. Okay, so this isn't the IV that is shown on the options chain. And the reason we don't use that is because the IV on an options chain is benchmarked to the SPY. What we want to know is what is the volatility of this stock benchmarked to itself over time. So that is why we use IV rank. You'll find that most platforms have it. I haven't seen a platform that doesn't have it, but I'll show you a few examples of where you can find it, but you can also look this up on barcharts.com. Now, the fact that we are going to be focusing on credit spreads, the thing that we want to make sure of is that the IV is high enough so there's some extra juice in those premiums to make it beneficial for us to sell premium. So my rules regarding this is that if the IV rank is greater than 30, that's when it's best to be selling options. If the IV rank is between 20 and 30, need to be extra picky with this and make sure that it is a really good setup. And if the IV rank is below 20, generally avoid it. There are a few occasions that you might have something that works in that range, but generally if it is below 20 IV, you don't want to trade it. And the reason for this is in that Black-Scholes model and the other models, part of their calculation for expected move is based off of the IV of that stock. So if you're selling premium and you're selling when that premium is low, and there's all of a sudden an IV spike in it, and that IV rank goes above 30, you'll find that you'll get a move against you on the premium side, even if the stock isn't actually moving. So we want to take advantage of that juiced premium and get in when the premium is high, so that way when it comes off, when that IV comes off, we're taking advantage of that. And here's a few examples up here on the top. This is Tasty Trade. You can see at the time that I took this, AMD had an IV rank of 48.8. On the right-hand side here, we have Thinkorswim. You can find this under the options chain. As you can see, you have to go down to today's options statistics. And they list it as current IV percentile. It is not IV percentile. They named it that for some reason. It is actually IV rank. And you can see that's coming in at a 44 on toss. So you can see they're fairly similar. And then you come over here to barchart.com. You can look this, this is free that you can go on to and look up. And you can see under the options overview, IV rank showing here at 48.2. My personal preference, I use Tasty Trade for all my options trading. And even if I am not trading in Tasty Trade, I use Tasty Trade to analyze the trades because they just have much better metrics, in my opinion, when it comes to analyzing options. But so there's a few examples of where you can find your IV rank. So the next thing that we do once we're looking at the IV rank and making sure that that is in the right levels that we want, with whatever stock it is that we're looking at, we want to take a look at events. Do they have earnings coming up? Do they have corporate events? These are all things that can't be calculated in the IV. So no matter what the expected move is, anything like that, anything that weird occurs or out of the norm with earnings or a corporate event like Apple Day or Tesla's AI Day, any of these where an announcement is made, pharmaceuticals is a big example. They are always going for approval for something. Well, those are events. and those can cause huge unexpected swings in the stocks. So we need to check to make sure that we don't have any of those that are going to be in the way of our trade. Once we've verified whether or not there are any type of events, the next thing we're going to look for is liquidity. So there are 3 things that I look at for liquidity. I find all of these on the options chain, and I'll show you an example after this slide. But the first thing I look for is volume. One activity on most strikes, but especially near the money. We want to see that there's volume trading. Now, obviously, depending on the time of day that you are looking, because volume is only showing that day's trade amount. Depending on the time you look, if you look at market open, there's going to be hardly anything there. You look towards the end of the day, the numbers are going to be drastically different on volume. The second thing we always look at is open interest. This tells you what is sitting out there ready to be traded. I always want to see at least one line with 1,000 or more open interest. The third thing I look at is bid-ask spread. You want to make sure that it is less than 10%. And I personally calculate it off of the ask, but you want to make sure that it is a fairly tight spread, because that is all. When you want to get out of this trade, you want to be able to get out of it for what you're expecting, and you want to be able to get out of it easy. And the bigger that spread is, the harder it's going to be to get out of that trade. So for me, when I look at these 3 things, it's a 2 out of 3. If it meets 2 out of the 3 and I like the trade setup, I am still within my guidelines to trade it. So maybe volume is a little light, but the open interest and bid-ask spread is great. Well, that meets my 2 out of 3 criteria and allows me to potentially take a trade on that stock. And here's the examples for you. You can see I just did this on AMD. You can see under open interest, this has 10,000 plus on multiple levels. So open interest is more than good enough. But even on less liquid stocks, if you're seeing stuff like this in here, where you're in the hundreds and you have at least one that is over 1,000 like this, and maybe these go back into the hundreds, that still meets my criteria, because we're breaking 1,000 on at least one, and we are showing activity on most strikes. And then the next one being volume that we look at, you can see, especially around the money, there is plenty of trading going on this. And then bid-ask spread, looking at the difference between these two, this is a 15-cent difference, which 10% would be around 71 cents, and it is well within that. So you can see this meets all 3 of those criterias. But for me, if let's say it meets the bid-ask and it meets the open interest, but volume's light, I could still potentially trade it if the rest of the metrics line up. So now that we've verified that this stock is even tradable for this strategy, the next thing that we have to do is determine, okay, what expiration are we going to trade? Well, studies done, Tastyworks has a lot of research into this. The CBOE has a lot of data showing all of this, that the best period to capitalize on theta decay is between 45 and 60 days. When you go out past 60 days, theta decay greatly reduces. And when you go below 45 days, you don't have enough time to truly capitalize on that theta decay. So for this strategy, I use a rule of between 45 and 60 days out. This gives us when theta starts accelerating, because it accelerates around that 60-day mark. So we're going to get some nice theta decay, but gamma is still at a minimal. We're not dealing with gamma risk. So I always stick to the monthly expirations. because there is better liquidity. And this is something that you can just go through, and even on some pretty liquid stocks like AMD, if you look at the monthly expiration versus the weekly expirations, you'll see that the weeklies are drastically lower in their volumes. So I always stick to the monthly expirations just to ensure that we have that liquidity that I want. Then when looking at an options chain, if there is no expiration between 45 and 60 days, I will go slightly less than 45 days. So maybe it's 40 days, 38 days. I will go there, but I will never go over 60 because that is taking the trade out way too long, and you're now having way too much time on your hands that you're not going to be taking advantage of theta. So as you can see here, I just pulled GLD as an example on here, that the monthly options expiration on Tasty Trade are always highlighted. So you can see there's a monthly at 28 days, a monthly at 56 days, and a monthly at 91 days. So if we were going to be trading this, we would be looking at the December 15 because it puts it 56 days out, which is perfect right between our 45 and 60 days. Now that we've selected our expiration, the next thing that we have to determine is what strikes are we going to trade. So I always start with my short strike as close to the 30 delta as possible, and then I will adjust from there. I will also start with a 5 wide and then adjust again based on risk tolerance and based on premium. And per my rules, I will never go above a 39 delta on my short strike. It's getting too close to the money for me. And the only time I will do a 39 delta is if I absolutely am in love with the setup. It has to meet every single aspect of the criteria perfectly in order for me to even consider a 39 delta. Otherwise, I try to stay as close to 30 as possible. So as you can see here, again, using GLD as an example on the day that I took these screenshots, the 31 delta is the closest to the 30. So that's the 179. Going 5 wide puts us at a 174. So we're selling the 179. We're buying the 174, giving us a 5 wide spread. On this, you can see that the premium that it's giving is $1.18. Okay, so this is how much they're willing to pay us in order to sell this spread. So now that we know what strikes we're looking at, we need to make the numbers match. This is where we put mathematical probability on our side. Okay, so the first thing that we're going to look at is we're going to look at premium. How much premium do we want to get on this trade to make it worthwhile? Okay, because back here, when you look at this, you see we're getting, it's showing $1.18 premium is what they're going to give us. But technically, we're risking $382 on this trade. Is that risk to reward worth it? Well, in my opinion, no, it is not. So this is where we start looking at those numbers. So I am always looking to try and get around 1/3 the width of my spread. So if I do a 5 wide spread, I am looking to get $1.67 out of that spread. If I'm doing a 10 wide, I'm looking for $3.34. The next thing that we look at, and this is one of the big reasons why I use Tasty Trade, is because how easy they make these numbers accessible, is probability of profit. This tells us based on those models what the probability is that we're going to profit on this trade. And when you look at it, theoretically, when you buy stock, you have a 50-50 chance because it's either going to go up or it's going to go down. So you're either going to make money or you're not. So if you know that buying stock, you only have a 50% chance, if we can trade in a way that gives us a higher probability of profit, that's the direction I would want to go. So for me, with those numbers, I want to see a probability of profit of at least 51% or higher. Extrinsic value must be positive, and your theta must be positive. So now taking a look at GLD again, we'll go back here where we can take a look at the first screen of this that I showed you, where we're only getting $1.18 premium. So the premium's not high enough on that. But if we look at probability of profit, it's at 70. Extrinsic value is 118. So we have positive extrinsic value and we have positive theta. So these match up, but we're just not getting enough premium on this one. So this is where adjusting your strikes can make the difference. And you can see on this example, I had to move this up to the 39 strike, or the 39 delta. And you can see it's still 5 wide, but moving it to the 39 delta, we still have a 65% probability of profit, 168 on our extrinsic value, and 0.81 on our theta. So all of those are matching what we are looking for, and premium is also matching exactly what we're looking for, which now takes our max profit to $168 and our max loss to $332. So this brings our risk to reward in line with a 2-to-1 ratio. So technically we are risking 2 to make 1. And when selling credit, lots of times you will find that people are risking a lot more than 2-to-1 to make profit. So we are really tightening up that level of risk. And this is the point where when analyzing stocks, that you move stuff around. You move the strikes around. You can try going 10 wide. You can stick to 5 wide to see if you can get these numbers to match what you need.
Now, Varian, if I may, when you take a max loss, do you often when you take a loss, do you often take your max loss, or do you sometimes take a lower loss?
It is very, very rare to take max loss. And in a slide coming up as to trade management, I will be discussing why that is. All right. So once we've got our metrics all the math makes sense here, the next thing that we do is we need to calculate contract size. So how many contracts do we trade? My rules, I use a 3% of net liquidity of my account per trade. So on a 5 wide spread, it has a risk. If we get our $1.67, it's going to have a risk of $3.34 per contract. All that is the width minus the premium received, multiply it by 100, and that gives you your risk per contract. You do, of course, have commissions and fees on top of that. But that is how I calculate my risk. So if you have a $10,000 account, I would trade 1 contract. If I have a $100,000 account, I would be trading 10 contracts. And that would put me at that around 3% risk to, around 3% risk of my net liquidity. So now that we've determined our strikes, we've determined our expiration, we've found the right setup, the math is all lining up, we're getting the premium that we're looking for, we execute the trade, we're now in this trade. So what I do as soon as I am in this trade, I immediately set a good till cancel order to close the spread at 50% of premium collected. So in the case of if I am receiving a $1.67 premium, I multiply that by 0.5. That gives me 84 cents is my good till cancel order to buy this back. So my goal on this is to capture 50% of that premium. And I just leave that order sitting out there to get filled. Now, when it comes to trade management, as Amit was bringing up, well, how do we manage these trades? So I always will close or manage a trade by 21 days to expiration. And the reason for this is that after 21 days, you deal with very high gamma risk. So once we get within that 21 days, gamma greatly starts increasing, and that makes it no longer mathematically beneficial to be in the trade, because gamma can just throw everything out of whack so quickly that that is something that we do not want to deal with in one of these trades. So I will always manage at 21 days to expiration. If my good till cancel order has not been hit at 21 days and I am profitable, I will close the trade for whatever profit there is. If at 21 days to expiration, the trade is down, I can roll the trade further out in time, but only for a credit. If I can't get a credit when I go to roll, I will close the trade for a loss. But if I can roll it out a month and I can get a credit for that, I will roll the trade out, getting that additional credit, because at that point, you are then reducing your risk into that trade. Every time you bring in a credit, your cost basis is reducing on it, making it easier to hit that profit target. And as Amit was bringing up, how often do these reach max loss? It is a very rare circumstance that these would ever reach max loss because of closing them at 21 days to expiration. Unless the market has made a severely drastic move, almost black swan-like, there will be premium left in that trade. Even if you are losing on the trade, there will still be premium left in it at 21 days to expiration. So it is unlikely that you would take max loss. And then in the rare occasion that it happens that, and I haven't seen it, it hasn't happened to me, but it is theoretically possible that your trade could go to max loss. If it did, that is the only time that I would keep a trade open past 21 days, because if you're already at max loss, there's no reason to close it. You might as well roll the dice on that last 21 days to see if maybe something changes and you might be able to get some premium back in it. So that is the only time that, per my rules for myself, that I would ever let a trade go past 21 days to expiration. All right.
Now,
Yeah.
Varian, for those who are new to this strategy, that seems like a lot of information. Can you give us an idea of when you're conducting your analysis? Let's say you've got a watch list of tickers that you're looking at. How long does it actually take to go through all these steps to, because again, you listed a lot of criteria for each ticker to determine whether or not it's going to be a trade that you're gonna enter or not. How long does it actually take to go through that analysis once you get good at it? I mean, I'm sure at the beginning you're I would imagine most traders would have to continue to look at their at a checklist.
Yep.
But once you get pretty good at it, how long does it take to conduct this analysis for each ticker?
On average, less than a minute.
Less than a minute. Okay, great.
And
Okay.
so when it comes to analyzing these trades, this strategy, this is all about how to trade the credit spread itself. So the technical side of when are you going to enter a trade? What chart pattern are you looking for? What technical analysis are you looking for? What astrological sign are you waiting to come in before you take a trade? This doesn't touch on any of that. So many traders out there have so many different styles of how to trade. They look for different chart patterns. They look for candlestick patterns. There's moving averages. There's all these different ways that traders will use to determine when they want to get into a trade.
Right.
What this does is it provides a greater mathematical probability of winning on that trade when you go to take it.
Gotcha. So you're not providing so in this course you're not actually talking about when to take the trade. What you're teaching is the best way of how to take the trade. Is that correct?
That is absolutely correct.
Great. Okay. But because it's a math-based approach, it will give you a mathematical or statistical edge in your trading if you follow these rules.
Exactly. If any trader that has a successful strategy that they are currently using for getting in and out of trades, if they incorporate this into whatever they use as a trigger to get in that is already successful for them, this will increase that success rate.
Gotcha. Okay. And well, let me ask you this. And how can, if someone wants to learn more as far as how you look for tickers, or how you build your watch list, or more importantly, if someone wanted to learn how, or even better, see how you actually conduct this analysis in real time, how could they do that?
Well, that is one of the greatest parts of what we have going on over at Down to Trade. So as you can see here, throwing up there for you to take a look at, over at Down to Trade, we have our swing trade room. That this is what we do every day, is we analyze these types of trades. So we look at chart patterns, we look at technicals, and we look for those setups for getting into these types of trades.
And this is done live, correct?
Yep.
Okay, great.
For the swing trade room specifically, most days are live. And if for some reason I am not able to do a live session on that day, I will generally do a recorded session for that day so we can take a look at the markets still. And then also we do ticker requests, and any tickers that people want to take a look at, they throw them into our private Discord, and we analyze those to see whether or not there's any good potential trade setups.
In fact, we just had one of those recently.
Yep.
One that yeah, I think only one of them recently was suggested by one of your members.
Yes, absolutely. One of the current ones top on my list was brought to my attention by one of our members.
Yep. Okay, great. And as far as so just to kind of get an idea, by the way, I love your strategy. I love what you do with it. I love your twist on it. It's such an amazing amazing approach to options trading, because it takes all of the guesswork out of how to make the trade successful, how to succeed in your swing trade strategy. So I love it, because again, no one no one wants to sit there and guess what they should do. You just spell it all out. Now, obviously, um, uh, it, for those of you who don't know, the live swing trade room that he's talking about is going to be open to the public as of November 1st. And it's a fantastic room. We've been running it for a while now to private members, but again, it's going to be open to the public here shortly. And again, the great thing is he does this live, and I know Varian, I'm sure you'll agree, this was a lot of information, and it could seem a little bit overwhelming when you're kind of just looking at it on, on a PowerPoint presentation. But
Absolutely. Yeah.
but when you're seeing it live, it's amazing how it just starts to click.
Yep. Yeah. And I mean, anybody that's even just watching the recording, watch it over and over again, pause it, follow the process, do it as we talk about it on here, and practice. Don't even take trades, just go through, find tickers. I know on Tasty Trade, you can look up high IV tickers, and you can just look at their, which ones have the highest IV and which ones can I trade, in the sense, not taking any trades, but just going through and practicing the setup, practice looking at those numbers, seeing how the numbers align, what works, what doesn't.
Right. I love it. Absolutely love it. And for those of you who might not know, if you are interested in seeing it live, whether or not you want to become a member of Down to Trade, but if you just want the chance to watch him trade live, you can absolutely do that for absolutely free. We are offering a 1-week free trial to the swing trade room. That way you can kind of come in, and again, you'll get 1 week's worth of trading with Varian live, doing this exact strategy. You'll get to see how he goes through his analysis. And he doesn't just do the analysis, quietly. He talks through it, and so you're learning by repetition. It's an amazing process, and it's amazing to watch how quickly your students are picking it up. It's so fantastic to watch and to see the learning curve just accelerate real quickly. So yeah, I would encourage you, if anyone is interested in watching him live, you can do it for absolutely free for an entire week, and there's no risk, no obligation. Just go to downtotrade.com. Keep in mind, right now, remember the live swing trade room actually isn't available to the public until November 1st, but we are offering a little bit of a sneak preview for anybody who jumps in our day trade. So there's kind of a workaround. If you sign up for a free trial with our day trade room, again, no risk there. But if you sign up for a free trial with our day trade room, you automatically also get a free trial to the swing trade room. So that's how you can actually get free access right now, even before November 1st. But if you're watching this after November 1st, just go to downtotrade.com and sign up to get access to the 1-week free trial for the swing trade room. Believe me, you're going to learn something. Now, obviously, Varian, my understanding, you were going to be offering a playbook or a strategy book. Is that correct?
That is correct.
Okay. And that strategy book, I would imagine, is going to cover everything you talked about today, plus more, I would imagine, right?
Yeah, there's a good 5-6 different strategies that'll be in that playbook that are fairly common strategies that I use.
Okay.
But not only that, when you join any of our rooms, when you become an actual paid member of our rooms, you do get a free 30-minute one-on-one session.
Like a coaching session.
Yeah, a coaching session, so that way we can help you just get your, hit the ground running, make sure you're all set up, answer all your questions just one-on-one, so that way you're ready to go with what it is we're doing.
I love it. I absolutely love it. And what about how do you track your trades? How do you journal your trades?
We have a official trade journal that all of our live trades go on to.
Okay.
And that is available in our Discord.
In our Discord. And is there one that is available? So you're saying that members can see your trades that you've taken, but is
Yep,
there a template that they can use for their own
absolutely.
trading?
Yep, the exact same trade journal that I use to track the trades for the room. Everyone has that is a paid member gets access to the same type of trade journal for them to track their own personal trades on.
I love it. I absolutely love it. Okay. So Ross is asking, what is the cost of the program? So Ross, that's actually going to be announced here in the next couple days. But I will say this: what we did work out is, again, there's kind of a workaround because anybody who is already a member of Down to Trade, in other words, if you're a member of our day trade um, membership or premium membership, then you're going to get a huge discount on the swing trade bundle bundle package. So you can go to downtotrade.com right now and check out the prices, check out the package. The only thing right now, because the swing trade room hasn't been officially launched, the prices are not listed on the website yet, but they will be in the next several days. And I would highly encourage you to, we still have about 10 days before the swing trade room is launched. I would highly encourage you to take advantage of this little loophole that we have. Go sign up for the day trade room. And again, by getting your 1 week free trial to the day trade room, you automatically, right now, you're going to automatically get your 1 week free trial to the swing trade room. And again, that way you can join Varian live every day in his day trade room. And you're going to learn a lot more trading with him live. It's one thing to see it here on the PowerPoint, but to see it happen in real time, that's where most of the learning does occur. And it's the same thing in the day trade room. Now I personally run the day trade room, and I've seen the same thing. I can sit here, PowerPoint, and teach everybody my entire strategy, but most of the learning does occur in the live trade room where we're actually walking you through the trades that we are personally taking, but we're discussing it out loud, and telling you. I like Varian does the same thing. I do the same thing in my day trade room. We kind of just we talk about what we're thinking at the moment, and that again, that's where most of the learning does occur.
Yeah, and the big thing about that is we specifically think out loud.
Yeah.
That is our whole goal, is to think out loud for our members, so that way we're, and lots of times we feel like we're rambling because we're just wanting to get all of our thoughts out, so that way our members can see, hear our thought process as to why we like a setup, why we don't like a setup, why we're looking at this. And they can just kind of get that whole idea based on, everything that is going on in our heads.
Very true. Very true.
So,
Okay.
I mean, one of the big things for both of our rooms, if you're looking for a room that you're just going to copy trades and that's it, that is not what our goal with our rooms are. We are here to help everyone become better traders on their own.
Yep.
So that's why we don't keep things secret. We're not just going, oh, I'm taking this trade, but I'm not going to tell you why. That's not what we're about. We want everybody to have the knowledge. We want everybody to learn these skills. And that's what we are here to teach is, this is why we're taking a trade. This is what I see. This is what I'm looking at. We want to give all of our members all that information.
Completely agree. I couldn't have said it any better. And Varian, it took a long time because I used to refuse to be one of those trade rooms that had trade alerts. And I refused to do it for a while because I didn't want to give out trade alerts, because no one's learning anything if all they're doing is looking at trade alerts. And again, that goes against our our mission at Down to Trade. We want traders to become more successful, not just trade successful. I want to see a shift in your mindset. I want to see you become a successful trader, and Varian does as well. So, but eventually I did break, and we did start offering trade alerts for those of you who can't make it to the live trade session every single day. We did start offering trade alerts, but obviously the bulk of the learning is going to come from the live trade sessions, without question. Yeah, great point, Varian. I love it.
And that's
Oh,
also why we record all of our sessions.
yes,
Is anybody that can't make it to our sessions, they can always go back and watch the recording and hear us talk through what we're doing.
absolutely, absolutely. And the great thing is about the recording our trade recording session library is that you actually get access to that as a free member. I'm sorry, as a free trialer. If you join up for a free trial, you'll get access to our entire recorded session library. So that's actually another great point. I appreciate that. Are there any other questions? Anything at all? Again, I know this was a lot of information, but it might seem a little bit overwhelming, but it really, if you watch it several times live, you'll be amazed at the number of light bulbs that just go off in your head. You'll just start to grasp it very quickly.
Yep. And just practice it one step at a time.
Yep, exactly.
Open up Thinkorswim or open up Tasty Trade. I personally highly recommend Tasty Trade for trading options because of their analysis. But just open it up and step by step through the class, do each step as we go through it. And the more you do it, the more you get used to it, then you'll quickly be able to recognize all of these factors that we're looking for. And, you know, as we mentioned, once you have a ticker, hey, I want to look up Clorox. You'll pull Clorox up, you'll pull up the options chain, and in a matter of less than a minute, you will know whether or not you're interested in trading it.
Love it. Absolutely love it. Okay, well, I think that's going to be it for the class. I appreciate everyone coming by. Keep an eye out for future classes. We try to do these about once a month, and every month we're going to try to continue to provide new courses in the world of options trading. Maybe once in a while in the future, we might consider getting into stock trading courses. But for right now, we are going to do our best to provide education on options courses, on options trading. So, and obviously we'll continue this into the future, and we certainly look forward to seeing you all in those subsequent classes. So, Varian, do you have anything further for anybody?
Nope, that is it.
Okay. Well, again, everybody, it's been a fantastic morning, fantastic class. Varian, thank you again for all that you do. And that'll be it for us. All right, everybody, take care.